A strong dollar is in America's national interest. It sounds reassuring, doesn't it? It sounds like strength, like stability, like something you should be proud of as an American. But what if I told you that this phrase, this cornerstone of modern American economic policy, is one of the most brilliant deceptions ever sold to the public? What if the strong dollar policy isn't about protecting your wealth at all, but about maintaining a global financial empire that quietly drains the middle class while enriching a select few? This is the untold story of how America built an economic illusion so powerful that even as it hollowed out the nation's industrial heartland, people still believed they were winning. To understand this deception, we need to travel back to August 1971, a moment that would fundamentally reshape global finance forever. President Richard Nixon appeared on television to make an announcement that would shock the world. He was closing the gold window, severing the last link between the dollar and gold. For decades, the Bretton Woods system had promised that dollars could be exchanged for gold at a fixed rate. But by 1971, that promise had become impossible to keep. The Vietnam War had drained America's gold reserves. Lyndon Johnson's Great Society programs had exploded federal spending, and nations like France, led by Charles de Gaulle, had started calling America's bluff, demanding gold in exchange for the dollars they held. The United States simply didn't have enough gold to honor its commitments. So Nixon did what empires do when backed into a corner. He changed the rules. Overnight, the dollar became a fiat currency, backed by nothing but faith in the American government. The immediate aftermath was catastrophic. The dollar collapsed in value. Inflation surged into double digits. Oil prices quadrupled during the 1973 crisis. Global confidence in American monetary management evaporated. The very foundation of American economic power was crumbling. Something dramatic had to be done, not just to save the domestic economy, but to ensure the dollar remained at the center of global commerce. What happened next was a masterstroke of geopolitical engineering that would reshape the world economy for the next 50 years. In 1974, Treasury Secretary William Simon traveled to Saudi Arabia for secret negotiations. The deal they struck was elegant in its simplicity and profound in its implications. Saudi Arabia would price its oil exclusively in dollars and persuade other OPEC nations to do the same. In exchange, the United States would provide military protection and security guarantees to the Saudi regime. This arrangement, which became known as the petrodollar system, was nothing short of genius from America's perspective. Oil was the lifeblood of the global economy. Every industrialized nation needed it. And now, to buy oil, you had to have dollars. This created an artificial but powerful global demand for American currency. Countries around the world were forced to hold dollar reserves and often to buy U.S. Treasury bonds just to ensure they could purchase the energy they needed to keep their economies running. Think about what this meant in practice. America could now print dollars, run massive budget deficits, and the rest of the world would willingly absorb those dollars because they needed them for oil purchases. The United States had effectively exported its inflation. This was the true birth of what would later be branded as the strong dollar policy. But it wasn't strong because of sound economic fundamentals or fiscal discipline. It was strong because the world had no alternative. The dollar became indispensable, and indispensability is the ultimate form of power in global finance. This system worked brilliantly for the American government and for Wall Street. Foreign capital flooded into U.S. markets. Other nations held trillions in U.S. Treasury bonds, effectively lending money to America at extremely low interest rates. But here's where the story takes a dark turn, because while the strong dollar elevated America's position in global finance, it quietly devastated the American worker. A strong dollar makes exports expensive and imports cheap. On the surface, this seems beneficial. American consumers got access to cheaper goods from abroad, but the cost was the systematic dismantling of America's industrial base. From the 1980s onward, as the dollar remained overvalued relative to other currencies, something tragic happened across the American heartland. Factories that had employed generations of workers shut down. Steel mills in Pennsylvania went dark. Auto plants in Michigan closed their doors. Textile factories in the Carolinas were abandoned. These weren't just jobs disappearing. These were entire communities built around manufacturing that were being hollowed out. The strong dollar made it impossible for American manufacturers to compete with foreign producers who had weaker currencies. Meanwhile, multinational corporations discovered they could boost their profit margins by moving production overseas, and the strong dollar made foreign labor even cheaper in dollar terms. Wall Street celebrated record profits. Corporate executives received massive bonuses. But the communities that had built America's middle class were left behind, casualties of a policy that prioritized financial markets over domestic production. Yet, through all of this, politicians continued to champion the strong dollar as if it were an unalloyed good. In the 1990s, Treasury Secretary Robert Rubin elevated the phrase to official doctrine. Rubin came from Goldman Sachs, and he understood the language of global capital markets. Every time he declared America's commitment to a strong dollar, markets rallied. Foreign investors interpreted it as a guarantee that their dollar-denominated assets would be protected. The statement itself became self-fulfilling. Capital flowed into American stocks and bonds, the dollar strengthened further, and asset prices soared. But Rubin wasn't protecting the American worker, earning $40,000 a year in a factory. He was protecting the hedge funds, pension systems, and foreign central banks that held trillions in dollar assets. The strong dollar policy was designed to attract capital, not to create prosperity for ordinary Americans. The 1990s appeared to vindicate this approach. Inflation remained low, partly because cheap imports suppressed consumer prices. The stock market boomed, creating what seemed like widespread wealth. The federal government even ran budget surpluses for a few years. On paper, everything looked magnificent. But beneath the surface, the structure of the American economy was being fundamentally transformed in ways that would prove nearly impossible to reverse. Manufacturing as a share of GDP declined steadily. Real wages for most workers stagnated. The economy was shifting from making things to buying things, from production to consumption, from creating value to extracting it through financial engineering. America was becoming dependent on foreign production for everything from basic consumer goods to advanced electronics and pharmaceuticals. And all of this was financed by debt, made possible by the strong dollar and the global demand for U.S. Treasury bonds. During the early 2000s, America's relationship with China became the defining feature of the global economy. China was rapidly industrializing, and it adopted a strategy of keeping its currency artificially weak against the dollar. This made Chinese exports incredibly cheap for American consumers. The United States bought enormous quantities of Chinese goods, running massive trade deficits. But here's where it gets interesting. China took the dollars it earned from these exports and used them to buy U.S. Treasury bonds. Essentially, China was lending America the money to buy Chinese products. Economists called this vendor financing, and it created a symbiotic but deeply dysfunctional relationship. America consumed more than it produced, accumulating debt. China produced more than it consumed, accumulating dollar reserves. Both countries became trapped in a system that neither could easily escape. The strong dollar made this entire arrangement possible, but it also meant America was trading away its manufacturing capacity for cheap goods and cheap credit. By 2008, the contradictions finally exploded. The global financial crisis exposed the dark side of the dollar system. When panic hit, the world rushed into dollars as a safe haven. The very system that caused the crisis reinforced itself. The dollar soared even as the U.S. economy collapsed. This paradox revealed the true nature of dollar dominance. The system had become so entrenched in global finance that even a crisis caused by American failures reinforced dollar supremacy. Countries and corporations around the world owed trillions in dollar-denominated debt. When the crisis hit, that debt became harder to repay as their currencies weakened against the dollar. This forced them to scramble for dollars, driving the currency even higher. The Federal Reserve's response was unprecedented. It created trillions of dollars through quantitative easing, purchasing treasury bonds and mortgage securities to inject liquidity into the system. It also established currency swap lines with foreign central banks, essentially lending them dollars to prevent a complete collapse. This wasn't altruism. The Fed understood that if foreign banks and governments couldn't access dollars, the panic would spread back to American markets. The entire episode demonstrated something crucial about dollar power. The United States could create dollars at will, while the rest of the world had to earn or borrow them. This is what the French finance minister had called America's exorbitant privilege back in the 1960s. And the financial crisis showed that this privilege had only grown stronger over the decades. But while America's financial system remained dominant, something troubling was happening to ordinary Americans. The recovery after 2008 was the slowest in modern American history. Real wages for median workers barely grew. Meanwhile, asset prices soared, driven by the Fed's low interest rate policies. If you owned stocks, real estate, or other investments, you became wealthier. If your wealth came from wages and savings, you fell further behind. Inequality exploded. The strong dollar narrative continued, masking the reality that most Americans were living in an economy that no longer worked for them. Growth was concentrated in financial centers like New York, San Francisco, and Washington, D.C., while much of the country struggled with declining industries and communities that felt forgotten. Here's the cruel truth that almost nobody discusses. The strong dollar doesn't just affect other countries. It affects you directly in ways you probably don't realize. When the Federal Reserve raises interest rates to defend the dollar's value, it makes your mortgage more expensive. Your credit card interest rises. Small business loans become harder to get. Car loans cost more. But at the same time, multinational corporations with access to international capital markets thrive. They can borrow in currencies other than dollars, invest in dollar assets, and profit from the exchange rate differences. The strong dollar creates a two-tier economy where large corporations and wealthy investors benefit, while ordinary workers and small businesses struggle under higher borrowing costs and stagnant wages. This is the hidden tax that nobody talks about. It doesn't appear on your pay stub, but you pay it every day. It's in the inflated housing prices driven by foreign money seeking dollar-denominated assets. It's in the stagnant wages that can't keep pace with the cost of living because the strong dollar makes offshoring labor more profitable. It's in the student loans and medical bills priced in dollars that are strong abroad but crushing at home. The strong dollar policy has quietly transferred trillions of dollars from labor to capital, from producers to financiers, from workers to creditors. It's one of the primary engines of inequality in the modern American economy, and it operates almost invisibly because it's wrapped in the flag of patriotism and national strength. To truly understand how this system extracts wealth from ordinary people, you need to see how it channels foreign money into American assets while suppressing domestic wages. When dollars are in high demand globally, the United States can create more of them without immediately triggering inflation in consumer goods. The rest of the world absorbs those dollars through trade, investment, and debt repayment. This is the essence of exorbitant privilege. America gets to live beyond its means because everyone else needs its currency. Foreign capital flows into U.S. stock markets, bond markets, and real estate, driving up the prices of these assets. If you already own substantial investments, this makes you richer. But if you're a young worker trying to buy your first home or save for retirement, these inflated asset prices make prosperity feel impossibly distant. The strong dollar suppresses inflation in goods you buy at the store, but it fuels massive inflation in assets you need to build wealth. This keeps you comfortable enough not to revolt, but never wealthy enough to escape the system. In recent years, cracks in this facade have become impossible to ignore. After the COVID pandemic, the Federal Reserve created more dollars in 2 years than in the previous decade combined. Trillions were printed to keep the economy from collapsing. Yet somehow, the dollar remained dominant globally. To casual observers, this seemed like proof that America's monetary system was invincible. But to those who understand international finance, it was evidence of how fragile the entire structure had become. The dollar's continued dominance no longer reflected American economic strength or fiscal discipline. It reflected the fact that the entire global financial system had been built on dollar-denominated debt. Countries, corporations, and banks around the world owed tens of trillions in dollars, and they had to service that debt regardless of what America did. This dependency created artificial demand that insulated the US from the worst consequences of its policies. But this setup was profoundly unstable. Inflation returned with a vengeance after 2020, revealing what many had suspected all along. The strong dollar had been masking monetary excess. Prices for food, energy, housing, and healthcare surged. The Federal Reserve, desperate to restore its credibility, began raising interest rates at the fastest pace in modern history. The dollar strengthened dramatically as a result, reaching multi-decade highs against other major currencies. The yen fell to levels not seen in decades. The euro approached parity with the dollar. The British pound crashed. Mainstream economists initially celebrated this as confirmation of America's relative strength. But the consequences were devastating for much of the world. Countries with dollar-denominated debt saw their repayment costs explode as their currencies weakened. Global trade slowed. Developing nations faced currency crises. The strong dollar, once a stabilizer, had become a weapon of financial destruction. And here's what you need to understand. This pattern is not new. It has happened repeatedly throughout modern history. In the 1980s, a strong dollar triggered the Latin American debt crisis, destroying economies across an entire continent. In the late 1990s, a surging dollar precipitated the Asian financial crisis, throwing millions into poverty from Thailand to Indonesia to South Korea. In the 2010s, emerging markets faced repeated waves of currency collapses whenever the dollar strengthened. Why does this keep happening? Because when the dollar rises, countries that borrowed in dollars find their debt burdens becoming impossible to manage. Their currencies fall, making dollar debt more expensive. They're forced into austerity, cutting government spending and social programs. Unemployment rises, political instability follows, and throughout all of this, capital flows back into US markets, reinforcing American financial dominance. The strong dollar acts as an invisible mechanism for extracting wealth from the global periphery and concentrating it in American financial centers. But increasingly, this mechanism is extracting wealth from ordinary Americans too. What's often forgotten in discussions of the strong dollar is that it encourages massive capital inflows into the United States. Foreign money floods into US bonds, stocks, and real estate. This pushes up asset prices dramatically, enriching the top 10% of Americans who own most of these assets. But for the working class, whose wealth comes from wages rather than investments, the result is stagnation and frustration. The strong dollar creates inflation in assets while suppressing inflation in goods, meaning houses and stocks become more expensive while your wages buy roughly the same amount at the grocery store. You're told the economy is strong because asset prices are rising and inflation is controlled, but you feel poorer because everything you need to build long-term wealth becomes less affordable. This is the silent cost of dollar supremacy that nobody wants to acknowledge. The average American is being priced out of prosperity by a system supposedly built in their name. Politicians can claim the dollar is strong while the people holding it grow economically weaker. Inflation statistics may appear controlled because cheap imports suppress consumer price indexes, but living standards quietly decline for most people. The strength of the dollar abroad actively contributes to the declining purchasing power of American wages at home. You can see this in housing affordability metrics, in the explosion of medical debt, in the erosion of retirement savings, in the fact that each generation now expects to be less prosperous than their parents. The government prints money and borrows endlessly, secure in the knowledge that foreign demand for dollars will absorb much of the inflationary impact. But the cost is borne by ordinary Americans through asset price inflation, wage suppression, and the systematic destruction of economic opportunity. Every empire in history has relied on a privileged currency. Rome had the denarius. Spain controlled silver flows from the New World. Britain's pound sterling dominated global trade for a century. In each case, monetary privilege led to overreach. Easy money allowed governments to fund endless wars, expand bureaucracies, and pacify citizens with subsidies and spectacle. But over time, the wealth extracted from the periphery could no longer sustain the center. The productive base eroded, debt accumulated, and eventually, the currency's dominance collapsed. The same dynamic is now unfolding with the dollar. America's financial power still dominates global markets, but its productive base has been systematically hollowed out. The dollar's role as the world's reserve currency has forced the United States into a devil's bargain. To supply the world with dollars, America must run perpetual trade deficits. To make its debt attractive to foreign buyers, it must maintain competitive interest rates. And to finance those deficits, it must issue ever more debt. It's a self-reinforcing loop that appears sustainable until the moment it isn't, and cracks are now visible everywhere for those willing to look. The BRICS nations have been building alternative payment systems to reduce their dependence on dollars. Central banks around the world have been buying gold at record rates, the highest levels in decades, as a hedge against dollar instability. Countries are increasingly settling bilateral trade in their own currencies rather than using dollars. China and Brazil trade in yuan and reais. India and Russia use rupees and rubles. Even longtime American allies like France and Saudi Arabia have explored non-dollar trade arrangements. These moves may seem incremental, but they represent a profound shift. The dollar's dominance is no longer seen as inevitable or entirely desirable. It's convenient for now, but it's increasingly viewed as a source of vulnerability. Domestically, the consequences of decades of strong dollar policy have become impossible to ignore. The manufacturing communities that once formed the backbone of America's middle class have been devastated. Cities like Detroit, once symbols of American industrial might, became symbols of urban decay. Factory towns saw populations decline and social fabric tear apart. Meanwhile, the primary beneficiaries of dollar dominance concentrated in just a handful of cities. Wall Street, Silicon Valley, and Washington, D.C. became the new centers of power and wealth. The dollar system redistributed wealth from the heartland to the coasts, from makers to takers, from workers to speculators. Every time the dollar strengthens, global capital pours into these financial centers, bidding up prices for everything. The wealth effect is real for those living in these bubbles. But for the rest of the country, the strong dollar means watching industries disappear and communities die. Here's an irony that should terrify anyone paying attention. While the dollar appears unbreakable from the outside, it's increasingly brittle from within. The entire system depends on perpetual confidence in the Federal Reserve's competence, in the Treasury's ability to manage debt, in America's political stability. But confidence isn't infinite. It doesn't erode linearly, but can collapse exponentially once a tipping point is reached. History demonstrates that reserve currencies lose their dominance, not because of external military defeat, but because of internal decay. Right now, the strong dollar is masking America's internal decay, hiding the rot beneath a veneer of financial credibility built on inertia and the lack of immediate alternatives. But warning signs are multiplying. Government debt exceeding $35 trillion and growing, declining productivity growth, accelerating deglobalization, rising social and political instability. These are the conditions that historically precede the loss of reserve currency status. When that transition occurs, and it seems increasingly a question of when rather than if, America's ability to borrow cheaply will vanish overnight. Interest rates will skyrocket. The cost of living will explode. And the same policymakers who spent decades preaching the gospel of a strong dollar will suddenly pivot to talking about exchange rate competitiveness and monetary flexibility, which are simply euphemisms for controlled devaluation. That's perhaps the ultimate irony of the strong dollar lie. When it finally collapses under the weight of its own contradictions, the very architects will reverse course and tell you that a weaker dollar is actually the solution. They'll frame it as restoring balance, creating jobs, boosting exports. But in reality, they'll merely be shifting the burden from the government's balance sheet directly onto yours. Inflation will erode your savings, your retirement accounts, your purchasing power, all so that Washington can inflate away its debts. The fundamental truth that nobody in power wants to acknowledge is that America has been living on borrowed credibility for half a century. The strength of the dollar isn't backed by gold reserves or industrial production or fiscal discipline. It's backed entirely by belief. Belief that the United States will always honor its debts. Belief that American political institutions will remain stable. Belief that the world has no better alternative. But belief is the most fragile foundation for a global monetary system. Once it cracks, no amount of official statements can repair it. When foreign investors start genuinely doubting the dollar's permanence, the exit will be swift and devastating. And in that moment of truth, all the slogans about American strength will mean absolutely nothing, because strength built on illusion is just weakness waiting to be exposed. The strong dollar policy may have built a financial empire that dominated the world for decades, but it also planted the seeds of its own inevitable undoing. Because you cannot build eternal power on borrowed belief and exported inflation. Eventually, always, the bill comes due. And when that reckoning finally arrives, the world will see the strong dollar for what it truly was all along. Not a sign of American strength, but the most elaborate confidence game in modern economic history.